Labor was in very high demand. We saw a lot of wage gains last year, and in order to get lured back, say for hospitality, leisure industries, they were demanding pay increases. And the unemployment rate actually is sitting at near 50-year low in the mid 3.5 range. If we see the unemployment rate going up drastically, that's a very negative sign. And so the fact that the unemployment rate has been steadily declining, labor demand in general is still very strong. So, one thing a lot of economists will look at essentially is the rate of change of the unemployment rate over a baseline. If you do see a quick increase in that rate of change, that can be a recession signal. Other parts of the economy might be slowing down, but labor continues to be very strong and is not signaling a recession at all. The Federal Reserve aggressively raised interest rates this year. You've seen inflation hit rates that we haven't seen for about 40 years, and the policy reaction was to raise rates to try to slow down demand, and of course with it bring inflation back down to more reasonable long-term target levels. The US dollar has been very strong relative to foreign currencies, and it largely was driven by the Fed raising rates aggressively and telegraphing to the world that they were going to continue raising rates until the Fed tamed inflation. Increased Treasury rates made the dollar more attractive as well, and we saw the dollar appreciate significantly relative to pretty much every foreign currency out there. That trend reversed somewhat early in the fourth quarter. It was due to a variety of reasons. Could have been the fact that the dollar was just simply overvalued on a purchasing power parity basis, but I think it was also related to central bank action from some of the other central banks around the world, like Bank of Japan and the ECB, coming out saying, hey, we're hawkish too, we're going to raise rates too to tame inflation. And then you saw, of course, a depreciation in the dollar relative to other currencies. I think the narrative has changed as we have ended the year, and that from where we stand, we think the Fed's more likely to pause on monetary policy and not pivot, notably because it takes time for interest rate hikes to affect the market. Things like interest rates around, say, mortgage rates might move instantaneously, but borrowing decisions for a company or capital expenditure decisions for a company takes some time. 6 months to 2 years is really when that full effect will take hold. And so I think the Fed's #1 priority here is to not repeat a mistake the last bout of high inflation, which was to assume that inflation was under control, and of course we saw a resurgence in uncontrolled inflation. So I think at this point the Fed's going to really focus on maintaining policy rate once they do get to their quote-unquote terminal rate, and see how it plays out in Main Street and not just on Wall Street. Thank you for watching. If you have any feedback, please let us know. My name is Kevin McCulley, again, Senior Advisor with Private Capital Management. We'll see you next quarter.